I'm 45 now, and looking back, it's wild how much of what I thought I knew about money was just wrong, especially when it came to investing. I used to think the market was all about numbers, spreadsheets, and cold, hard data. If a company had great earnings, its stock would go up. If the economy was strong, the market would follow. It seemed so logical, so predictable. But my first few years of investing taught me a lesson that no textbook ever could. The market isn't a calculator, it's a crowd. And crowds are emotional, irrational, and incredibly powerful. I started investing in my mid-20s, right after I got my first real job. I didn't have much, just a few $100s a month scraped together from my paycheck. My strategy was simple: buy stocks in companies I knew and liked. Tech giants, popular brands, you name it. For a while, it worked. The market was in a good mood, and my small portfolio started to grow. I felt like a genius. I'd check my account every day, watching the green numbers climb, feeling that little thrill of victory. I was convinced I had a knack for this. My first real test came with a stock I'll just call Future Tech. It was a smaller, exciting company that was getting a ton of media buzz. Everyone on social media and in the financial news was talking about it. The story was incredible. They were developing this revolutionary technology that was going to change everything. Their stock price was already climbing fast, and the fear of missing out, or FOMO, hit me hard. Every day I waited, the price went up another few percent. I could almost hear a clock ticking. So, I broke my own simple rule. I sold some of my stable, boring stocks and put a significant chunk of my money into Future Tech, right near its peak. For a week, I felt like I was on top of the world. The stock continued to inch higher, and I was patting myself on the back. But then, the mood shifted. A report came out questioning their technology. It wasn't a definitive takedown, just a seed of doubt. But that's all it took. The chatter online turned from excitement to anxiety. People started asking questions. The price dipped a little. Then it dipped a lot. I remember staring at my phone, watching the value of my investment shrink in real time. My heart was pounding. All the logic I thought I had went out the window. My first instinct wasn't to reevaluate the company's fundamentals. It was pure panic. I have to sell, I thought. I have to get out before it goes to zero. And that's exactly what I did. I sold everything at a substantial loss. Of course, a few months later, the company addressed the concerns, released some positive data, and the stock slowly began to recover. Had I held on, I would have eventually broken even and even made a small profit. But I didn't. I let the collective fear of the crowd dictate my decision. I bought because of collective greed, and I sold because of collective panic. I wasn't investing in a company, I was just reacting to the noise. That experience was my turning point. It was a painful, expensive lesson, but it forced me to see the market for what it truly is, a battleground of human psychology. It's driven by two of the most powerful emotions we have, fear and greed. When people are greedy, they see every stock as a rocket ship to the moon. They ignore warning signs, they overpay for assets, and they create bubbles. The story matters more than the numbers. Think about it: when a stock is soaring, the news stories are all about its limitless potential. We get swept up in the narrative, the dream of what could be. We feel euphoric, invincible. That's greed in action. Then there's fear. When the market starts to turn, that optimism evaporates. Suddenly, every news headline is about recession, collapse, and crisis. A stock that was a strong buy yesterday is suddenly a sell at all costs. The story flips. People who were bragging about their gains are now silent, or worse, they're leading the charge of panic selling. They sell good assets at a loss just to stop the pain, to feel some sense of control. They're not thinking about the company's long-term value anymore. They're just trying to get to safety. That's fear. What I lost with Future Tech wasn't just money. It was the opportunity to learn this lesson cheaply. It cost me a few $1,000s, which felt like a fortune at the time. But more than that, I lost months of potential growth in the solid, boring companies I had sold. I traded a sound, slow and steady strategy for a roller coaster ride driven by hype. I can't get that time or that capital back. It's a sunk cost, a scar from my early days as an investor. It's a reminder that chasing the crowd is often a race to the cliff's edge. So here's what I wish I knew back then. I wish someone had told me that understanding market psychology is just as important as reading a balance sheet. The numbers tell you what a company is worth, but psychology tells you what people are willing to pay for it, and those two things can be worlds apart. The market will always swing between irrational optimism and unjustified pessimism. That's its nature. Your job as an investor isn't to ride those emotional waves. It's to have a plan, a strategy based on your own research and your own goals, and to stick to it. It means being brave enough to buy when everyone else is fearful and smart enough to be cautious when everyone else is greedy. It means turning off the noise. Don't check your portfolio every day. Don't get your investment advice from hyped-up social media posts. Do your own homework. Understand what you own and why you own it. Most importantly, know yourself. Are you prone to FOMO? Do you panic when things go down? Be honest. If you are, maybe a simple, automated strategy like investing in low-cost index funds is better for you. There's no shame in that. The best strategy is the one you can stick with, through good times and bad. You have to build a system that protects you from your own worst emotional impulses. Because in the end, the biggest enemy to your financial success isn't a market crash, it's the person you see in the mirror. Looking back, that painful loss was probably the best investment I ever made. It taught me to be a thinker, not a follower. It taught me that real wealth isn't built in a day of frantic trading, it's built over years of patient, discipline, and unemotional decision-making. The market will always be a chaotic, emotional place. But your financial plan doesn't have to be. Thanks for listening.